Most of us have heard about the stock market, but what exactly is it and how does it actually work? In this video, we will break down in a simple and easy to understand way. So without any delay, let's jump into the first part. The stock market is a place where people buy and sell shares of one or more companies. To understand this better, let's compare it to a used car market. Here, people buy and sell cars that belong to individuals or companies. Just like how car changes ownership in the used car market, share changes ownership in the stock exchange. Many people imagine the stock market as one big place where everyone buys and sells shares, but that's not really the case. In reality, stock market is a network of stock exchanges. For example, in the United States, two major stock exchanges are the New York Stock Exchange, home to companies like Coca-Cola, IBM, and Johnson & Johnson. Nasdaq, known for tech giants like Apple, Microsoft, Google, and Tesla. In Germany, the main stock exchange is Frankfurt Stock Exchange. And in India, the Bombay Stock Exchange, one of the oldest in Asia, and the National Stock Exchange, where companies like Reliance, TCS, and Infosys are listed. Now let's dive a little deeper to understand which types of companies can list shares, and most importantly, what exactly a share is. Let's start with the companies first. Broadly speaking, there are three major types of companies. First, privately owned companies. These are owned by an individual, a family, or a small group of people. Examples include Deloitte and Ernst & Young in United States, Flipkart and Ola Cabs in India, Bosch and Aldi Group in Germany. Second, government-owned companies, often called public sector companies. Here, government owns the company. In many countries, services like railways and postal services are government owned. And third, publicly owned companies. These are companies whose ownership is distributed among the general public through shares. In this context, a share is a unit of ownership in a company. Examples include Apple and Microsoft in United States, TCS and Infosys in India, and Volkswagen and Siemens in Germany. Out of these three types, only publicly owned companies are relevant to the stock market. By now, it should be clear why you don't see certain companies listed in your brokerage app. You can only buy shares of a publicly owned companies, not just any company. We have talked about what the stock market is, and you are probably wondering how the publicly owned companies are founded, who owns what portion, and how can anyone buy shares of a company. Let's dive a little deeper to find out. A quick pause. We have invested considerable time and effort in researching, verifying, and producing this video. If you are finding it useful, please like and subscribe to stay updated with our future content. Now let's continue with the video. It all starts with the creation of a publicly owned company. A company can technically be founded directly as a public company, but that's pretty rare. In most cases, a privately owned company eventually transforms into a public one, or sometimes even government-owned company makes that shift to become publicly owned. For better understanding, let's take an example. Imagine a privately owned company that decides to go public. There could be several reasons behind this decision. Most commonly, to raise money for growth, to pay off existing debt, or to let early investors sell part of their shares. Now let's look at the major steps involved in transforming a company from private to public. The very first step is that the company hires one or more investment banks along with the financial advisors to guide them through the process of going public. These investment banks, also known as underwriters, conduct a deep financial analysis of the company. They look into everything: revenue, profits, assets, liabilities, growth potential, competitors, and much more. Using all this information, the investment banks estimate company's total valuation, or in simple terms, its total worth. For example, let's say the company is valued at $1 billion. That value is then split into shares, for instance 50 million shares, which would make each share worth $20. Next, the company and the investment banks decide how much of the company to offer to the public, usually somewhere between 10 and 25%. Let's take 80% they keep and 20% they sell to public. That means 10 million shares will be sold to the public while the remaining 40 million shares stay with the company's insiders. Within that 80%, it could be divided among the founders, for instance, 40%, existing investors 30%, and employees 10%. After finalizing all these details, the company, with the help of its investment banks, moves forward with the process and submits all necessary documents for regulatory approval. Once it's approved, the company's leadership, along with the investment banks, finally steps into the spotlight. They offer the 20% of shares which we talked about earlier to investors in what's called the primary market. And this process has a familiar name, the IPO, or initial public offering. Now here where it gets interesting. Out of that 20%, roughly 60% usually goes to big institutional investors. Think mutual funds, pension funds, and insurance companies. About 30% is set aside for retail investors. That's regular people like you and me who want to own a piece of the company. And the remaining 10% is often reserved for wealthy individual investors or employees. But here is something important to know. IPO shares are not available forever. They are usually open for a limited time, typically around 2 weeks to a month, during which all the offered shares are sold to investors. Once all those IPO shares are sold, the formal IPO process officially closes. At this point, the company has successfully raised money from the public, let's say around 200 million, which now goes straight into the company's bank account. That's the fresh capital the company can use to expand its business, pay off debts, or invest in new projects. And here is the really important part. Once the IPO process closes, the company has successfully transformed from a private company into a publicly owned company. And from here, the next big step begins. The company's shares are ready to start trading publicly on the stock exchange. Now those 20% shares or 10 million shares are officially listed on the stock exchange, which is also known as the secondary market. This is the market we are all familiar with, the one where people like you and me can buy and sell shares freely. Some popular examples include New York Stock Exchange, Frankfurt Stock Exchange, and Bombay Stock Exchange. Once the shares are listed on the stock exchange, they can be freely traded between the investors. At this stage, the company is not directly involved on these transactions anymore. It's all between the people who already own the shares. If you buy a share, it means someone else is selling it. The company doesn't get that money again. The ownership just changes the hands on the exchange. Investors buy shares hoping the company will grow and the share price will go up so they can sell later for a profit. On the other hand, sellers might think the price will drop, or they simply want to book profit or move their money elsewhere. Well, buying and selling is not easy as explained. There is a lot happening behind the scenes when shares are bought and sold. When you place an order through your broker's app, it doesn't just magically appear in someone else's account. Instead, your order goes to the stock exchange's trading system where millions of buy and sell orders are automatically matched in real time. If your buy price matches someone's sell price, the trade is executed. The shares are transferred to your account and the money goes to the seller. It's important to know that the share prices can change every second, all based on supply and demand. Think of it like an auction for a popular gadget. If more people want to buy, price goes up. If more people want to sell, price goes down. This is exactly how the stock market works, the everyday stock trading we often hear about in the news. Thanks for watching. Don't forget to hit like and subscribe. See you in the next video.